HOEC. Blockbuster quarter, quite frankly. Had it not been for depreciation, I think the bottom line numbers would have looked even better. But not a bad quarter. Top line's grown well. EBITDA showing really good and strong numbers too. Mr. P. Elango of HOEC, Managing Director of HOEC, joins us right now on the show to talk about the numbers and the outlook ahead. Good having you, Mr. Elango. Thanks so much for joining in. Simple question: what led to this performance? Because it's taken the best of most of the analysts by surprise.
Okay, thank you. I think the first time our quarterly results reflect the 1 month of production from Assam. As you know that we commenced the commercial gas sales from Assam on 26th of August. So in this quarter result, you are seeing the numbers of September. So that kind of sets a tone for continuing increase from operating revenue quarter after quarter from now onwards. We are looking at ramping up the Assam production almost 3 times over the next 6 months period. So effective 1st April, the total volume of gas sales from Assam would be about 1 million standard cubic meters and about 1,000 barrels of condensate. So we are right now executing the phase 2 of the facilities, and they are on track to commence. So this quarter basically results just 1 month of the Assam production.
Wow. So is 1 month of Assam production, which is also not peak production, and your revenues have moved up 126% higher on a quarter-on-quarter basis. What is this? What does this portray in terms of basic numbers on the revenue front for the rest of the year? I mean, what would you do in quarter 3 and quarter 4 with all 3 months of production available? And I would presume from your answer, a ramped up production available.
Yeah, essentially for the next 2 quarters, the production from Assam would be around the same numbers. We are expecting to commission the full facilities in the last quarter of this year. So you would see from the first quarter of next year the full volume numbers as such. So, but overall, compared to last year, what you would see is our revenue from operations would start climbing up. Right now, our run rate for HOEC is about 4 crore per month is what you would see going forward.
Mr. Elango, please correct me if I'm wrong, but even though the ramped up production would only be next financial year, the second half of this financial year will see all 3 months getting the benefit from the Assam production. So there is a natural tailwind to your revenues in this year as well, and next year you have a ramped up production.
Yes.
So I would presume for the next 4 quarters,
absolutely,
you would have a revenue, or next 6 quarters, you will have a revenue run rate which is much, much higher than the current quarter.
Absolutely, yes.
Okay. Now, the other bit is that the uptick in EBITDA, is it a natural course of what's happened to revenues, or are there other factors to it? Because the margins have really shown a sharp uptick. Are these margins sustainable?
Yes, it is sustainable. So what we have done in the main field in Assam, we have gone for a fixed operating cost model. What do I mean by that is gone from modernized gas processing plant that will be commissioned from 1st April, which would see where our operating costs are fixed. Roughly, our operating costs would be less than 60 cents per unit of gas, against the price that we would realize about $3 per unit of gas. So you could see, the operating margins are in the order of 75% or so. So cost base would remain low, and what you're seeing is because the very low cost operations we have.
Wow. And when does this heightened depreciation play out? Because the only thing which curtailed your bottom line performance optically was this heightened depreciation number. Does this end in a hurry, or will these depreciation numbers stay high for the foreseeable future?
No, the depreciation would, we would be capitalizing some of our facilities that we have created in Assam over the next 2 quarters by end of the year, essentially. So you would see that reflecting in depreciation. But otherwise, on a cash basis, we're really looking at some very healthy numbers going forward.
Certainly see that. One question is on the unified tariff, which has been announced by PNGRB. My analyst Somit wanted to ask this to you. And I mean, how will that help the company, and can we expect further cost reductions as a result of this?
Not really, because what we have done in our facilities, we have built our own pipeline to customers. The gas that's being produced in Assam is being sold to Oil India, and we have laid a pipeline up to the Oil India facilities. So essentially, we don't get any impact due to the change in the tariff structure as such. What we are benefit from is really you're seeing a hardening of oil prices. For example, last quarter our average realized price was about $49. This quarter is about $52, and over a period of time this increased oil price would reflect in an increased gas price in the domestic market as well, while our cost base will continue to remain stable. Therefore, any increase in gas and oil price would really go to our bottom line straight.
Okay, which is great. So, Mr. Elango, my final question, and just so much about the numbers really this quarter. Haven't had the chance to do more. One, would you need to kind of do any fundraising? That is one. But two, more importantly, just as a vision, not really the next 1 or 2 quarters, but say post the next 18 months, when you take in all the benefits out of the plans that you have had and the vision that you have established, would it be fair to assume that your quarterly revenues could inch up to northwards of, I mean, I'm just throwing out a number there, higher teens or maybe northwards of 20 crores, 25 crores. Could you hit those numbers very soon?
That's what our vision is essentially now. First thing is to kind of complete this ramp up in Assam production. When we do that, at the beginning of next year, we would see a daily revenue of about 40 lakhs per day net to HOEC, which would translate to roughly about 120 crores of top line for HOEC as a whole, including our current production facilities. So as I said, our operating costs are fairly low. Therefore, they are roughly about 10 crore in Assam, another 10 crore if you add in the other facilities. So we are looking at a number of about 100 crore for the next financial year as a whole. Our next target is really focusing on reviving the production from PY1 offshore field, where we have come up with a 3-well intervention campaign. So we are planning to invest about 100 crore in that oil field, which is oil and gas field, which is fully owned by HOEC. So we are looking at executing this campaign. I mean, it will commence in first quarter of next financial year. So in the first half of next financial year, we should be completing this program. That should result in increasing the PY1 production by about 3 times. Right now we are producing about 3 million cubic feet per day. That would go about 10 million standard cubic feet per day. So that's 100% owned by HOEC. With that, we are looking at another roughly 100 crore to add in the subsequent financial year. That is about 1920. In 2021, our vision is to start the production from the discovered small field, which is B18 Mumbai High. That we've just submitting the field development plan. So overall, the approach the company will have is to look at one project at a time, execute it on a low cost and fast track basis, and then add to the cash flow and earnings.